Hi, every time when you think of starting a business, and I know you're thinking about what kind of business it's going to be, you're thinking about business structures. And in this section, we will talk about the details of these structures, how that would work for you. And we call that secrets of those business structures because no one have ever put it together the way we do. And we guarantee that you will learn a lot and know what to pick for yourself. Now, let's get going. These are the most used business structures in United States of America. And these are things that you probably know really well. And you know what is sole proprietorship. And you also know what is LLC, s-corp, c-corp, but not for-profit organization. So these are the structure you see all the time. Then you want to know that, okay, so what's so secret about these entities? So this is the webinar that we will dive in and talk about the difference. And I will showcase you how that is different from others. And I want you to kind of envisioning those entities, the structures, as a separate like separate balls, separate from each other. Sole proprietorship is really part of your personal thing. It is under your social security number and under your name. The LLC is a membership organization. They don't call it owners, they call them members. S-corp and c-corp are shareholders. And your not-for-profit organization has no owners, just board of directors. Okay, so these are general guidelines of these 5 entities. Let's just go talk about them. So why sole proprietorship? You might say that, in what case I would want to be a sole proprietor? And in some cases, people want to be sole proprietor. For example, if they don't want to spend money to set up business, and they want to save on the startup cost. And of course, sole proprietor, you don't need to set up anything. You can just declare, I am in business today. I am in business this year. And I am doing snow shoveling because we got a big snow. So that's my business. And I went to my neighbor. I asked for, do you need help? And I help. So I start a business, snow blowing. And this is the beginning of it. I don't need any formation. So that is to save on the startup cost. And the loss to offset the income. So sole proprietors, because I am using my name and my social security number to run the business. So it is actually inside, of my 1040. If I run a loss, for example, and if I run a loss on my sole proprietor business, and my other income will be reduced. So therefore, I might have more refund. Say if my W-2 is $50,000, and I run a sole proprietorship for $50,000 loss. And then what's gonna happen? My taxable income is 0, right? And the taxes you already get withheld by the employer would come back to you as a refund. So this is where sole proprietorship is actually attractive. But why not? There are people don't want to be sole proprietor. They don't think this entity, this is the good way to do business. And we tell you why. Risk of audit. And under Schedule C, and every major IRS office around the country, and in the building, they have a special unit. They call that self-employed business unit. They audit nothing but Schedule C business owners. So there is a higher risk of being audited under Schedule C. That's just a fact. And it's not because of any other reason, because you are new, because you are a new business owner, you probably don't know what you're doing, and you maybe need more education. So IRS want to catch you early, so they give you a better education so you know how to deduct your business expenses. Nothing wrong with that, right? So that's just the business approach IRS is taking. And the nature of Schedule C are so similar to hobby. So IRS is in the active role to say that no, that is not your business. That is your hobby. When it has become a hobby, you cannot deduct the expenses. Say if you collect stamps, so many years ago, stamp collection is a big deal, right? Now, who use stamps? It's just all electronic signature and email, text, and Instagram and Twitter. So who use stamps? But say you were collecting stamps in the past and you want to make that a business, no, that would become a hobby. So the nature of Schedule C so easily become a hobby. That is where IRS is also looking at. And if you do think that, well, this is look like a hobby, but it's really not a hobby, and I don't think it is a hobby, then you probably shouldn't be running it under sole proprietorship. And sole proprietorship income is taxed double. Double means it is taxed on income tax. It is also taxed on self-employment tax. Sole proprietor just means that you're running the business on your own. So if you made profit, obviously it is earned income. So supposedly to charge Social Security, Medicare, so it's called self-employment tax. That is a 15%. So this is where you can see why sole proprietorship, and we have some savings. If we have a loss, we have that offset income. And why not, why people don't want to do that? Risk audit, nature of the Schedule C with hobbies, and the tax being double. So this is where the sole proprietorship is coming in. So you want to consider all of that and to decide what you want to do. So maybe when you just start a business, you know that your first year, your second year, you're gonna have a loss. Then nothing wrong to do it under sole proprietor. And that way you can reduce your other income. You might even get more child tax credit and earned income tax credit if you do that, right? If you have more loss. So you reduce your AGI. So that is sole proprietorship, okay? The next one I have is YLLC. LLC is very interesting. LLC is the most flexible structure. So I am going to actually change my screen and to a whiteboard because I want to write to you about the LLC. So let's stop sharing my slide and I will share with you a whiteboard. Whiteboard is basically just like the whiteboard in the classroom, and you will see what I am doing right here. So I guess right now you're seeing a sign called hi, right? So let's just erase that because we don't need that. And let's just talk about LLC. So I have a LLC. Kat, can you confirm that the drawing is showing?
Yes, it's a box.
Great. So one of the reasons people like to have a LLC is flexibility in structure of partnership within LLC. So this is your LLC, right? And inside of your LLC, when you do your operating agreement, and you have three things that you ultimately need to decide. One is your equity, one is your profit, one is your loss. So let's say you and your spouse is operating an LLC. Two of you are the members, two of you. And you want to figure out and what is the how the loss is distributed, how the profit is distributed, how the equity is distributed. And one thing you know that is you can have different percentage for all of these elements. I know when I talk about if you're a wife and a husband and a spouse, and because you file joint return, so these profit and loss may be not making a lot of sense to you because you're going to combine them anyway. But know that these profit and loss can also have implementations of whether those profit should subject to self-employment tax or not. So there's a flexibility in setting it up. So if I am working this business with my spouse, and of course, we will be, I want to say that 60-40, okay? Because my spouse is the one really working on it. I am just the one that watching him struggle, right? So when there is a profit, I may say it's still 60-40, but my 40 has no self-employment tax because I am not working in it. I am simply an investor, but he is working in it and he sweat, so he is working in it. So his 60% will pay self-employment tax. Okay, if it is loss, fine, 60-40, it's still gonna be 100% going into our joint return 1040, right? So in this household setting, and you realize that there is a significant difference on the profit. If you made profit and one is an investor, the other one is working in the LLC, then you save 15% taxes right here. The most significant, I have a really successful story over this one. So I had a client so many years ago, and they are LLC. They own hotels. So every hotel is LLC. The husband and the wife, they both own it. When I interviewed them, and they were telling me that, well, you know, the hotel's profit and is coming to our tax return, we pay a lot of taxes. So I met both of them. I asked the wife, what do you do in the hotel? She goes, what do you mean? I don't do anything in the hotel. I don't even want to go there. Those hotels, I don't care. I don't go there. So she had never, ever even stepped into the hotel. So her percentage of that hotel should not pay self-employment tax. Am I right? Because she is just an investor. She just have a membership and she didn't really get involved. Only the husband should. And I just want to give you an idea of that saving. And out of this one simple idea, to make sure we classify her properly, that was $65,000 a year saving on taxes. That is how significant it is on the operating agreement. So my first point to you is understand the flexibility in structure with LLC. And if you are partner with somebody else, for example, you partner with somebody and they give you money and you work, okay, with another person, and this person is wealthier than you are. So your agreement could be that if there is a loss, this person has 90%, you have 10%. If there is a gain, you have 90%, that person have 10%, but on equity is 50-50. So these percentage can be negotiated. And these percentage will be reflected on your tax return when you file taxes. So that rich person can take losses to his tax return, get more, reduce their tax liability. So this is number one, why LLC? Because LLC has flexibility. It is very good. And LLC also have a flexibility. This is my number 2 point in handling business expenses. Okay. For example, let's say you partner with somebody and this partner of yours is very adamant about not charging anything to the partnership. No, I don't want to take your cell phone charges. No, you cannot claim mileage. No. We don't want to do that. We only just want to count for business expenses that related to the LLC. No, now your personal, nothing. If you have a partner like that, LLC offer you a structure flexibility. You can take your K1 because LLC will give you the K1, right? You take your K1, you go to your 1040. This is your 1040. You can file your expenses in the 1040 against your K1 income, which means let's say this LLC give you $1,000 K1 income. Okay. And in your 1040, you can reduce that by your expense. Maybe your expense is $3,000 because you have your cell phone expense, you have your other expenses that your partner don't allow you to put in. So you're just coming over here in your own taxes, not your partner's tax. Okay, in your own tax return, you will put in your expenses related to running that LLC, but not reimbursed by the company. So you come over here, you will get deduction right here. So this is where the second point we want to say yes LLC, because it gives us flexibility in handling our own business related expense. And LLC number 3, yes LLC, because the audit risk is low. LLC is one of the most complex taxes out there in our system. And LLC has so many ways to run and it's so different. And a lot of large companies are LLC. So when you have large companies are LLC, it ultimately bringing the audit focus to larger company, right? That's why President Trump's tax return is under audit because he runs large corporations. So with that, the relatively speaking, compared to Schedule C, sole proprietorship, you do have a lesser tax audit rate. And the LLC number 4 I have here is what I call the title holding and a risk shelter. This is a different kind of LLC, folks. So the LLC has two kind of LLC here. One of them is what I was doing, and that's a business, right? Earlier, I was giving you the LLC. That's a business LLC. It runs active business activity. The other kind of LLC is what we call the title holding LLC. It just holds the title, does nothing else. And if it holds the title and the member is just one person, then this title, you have no tax filing needs. You don't even need to file taxes because it just holds the title. You are the title holder. So it is just on your income tax return. If you ever rent that out, if you don't, and there is no need to file tax return. But when you have an LLC, that is business LLC. Yes, you do, because remember you have income, you have expense, right? You have income, you have expense, then you have profit. When you have profit, you split the profit to K1 to your different partner. And if you don't allow me to deduct all the expenses out of the LLC, me as a partner, we can deduct my expenses under my 1040, right? So that is LLC earlier we talked about. But this title holding LLC is marvelous. It is protecting your asset with one more layer. So let's say if you have a house and you have the house title under LLC, then it is one more protection. Basically, people cannot get into that. That's a liability protection. Protecting you having liability over this title. So it's a clean title and you protect it under LLC. So that is a title holding risk shelter. And LLC has something really, really interesting. You know how when you think of a business, sole proprietor is you, right? Is you. And you know, the LLC member, and you will wonder that, okay, I can be the member. Yes, a person can be the member, but the LLC member can also be what? Can also be corporation and other LLCs and the foreign entities. So LLC members are can be so different. They don't have to be just you and your spouse. They can be a company. So let me give you an example. What do you mean by that? Okay, so what I mean by that is you have an LLC and is owned by a person, by a company, and also by a foreign entity. Could be a foreign person, could be a foreign company. Okay, so these are members. So when LLC makes money, it will go to this person as a K1, to this person, so it goes to 1040. Company, it is a K1, goes to the company, then it goes to 1120. That's a tax form. Just like this one, it's a tax form. And the K1 goes to the foreign, so they file foreign tax here in US, non-residents. Okay, so LLC don't have to have any person. And let's say if I am a person and owner of this corporation, and this corporation will take the other business, which is LLC, income into here, and this corporation pay taxes right here, didn't I completely disappear from this transaction? I, as a person, I do not have to be in business, but pay taxes on my own. I don't have to. It can be passed down all the way to a corporation. So I can go away from even account that money to myself. For whatever reason, if I don't want to make money, for whatever reason, I couldn't think of any, but maybe you can think of something, then the structure will come handy. And you know how to structure that out. And it can be in the corporation, it can be in the LLC, but the member is a company. So that's another thing about the flexibility of LLC. A US LLC can be owned by entirely by a foreign person. United States tax laws require that foreigners pay taxes on any earnings made in United States, regardless of immigration status. Okay, so you can be a student visa and you can be all kind of visa status, the United States will allow foreigner to form a company as long as they have registered for taxpayer identification number. So what I am saying here is you can be a foreigner. You can be someone coming in without status. But as long as you apply for IT number, individual tax identification number, apply for that, then you can have an LLC. You can form a company. And LLC allows foreigner to be a member. So this is where your understanding of the structure would help you to know where you can land your business based on your status, okay? And some people say, well, we don't want to be LLC because it has tax double. Yes, remember in the first chart we drew where the spouse worked on 60% and that spouse has to pay what? Income tax and also self-employment tax, right? So that is where the two taxes coming in. Yes, LLC has that. And when you have an LLC and someone works in the LLC, that person needs to pay self-employment tax. And the other thing about LLC is if you are a single member LLC, if you are just one member of LLC, no, not 2, 3, that means you defaulted back to 1040. You are sole proprietor in that case, if you are a single member LLC. So some people will say that, well, I'm an LLC, and so I have a company. Yes, you do. But from tax standpoint, you are actually under 1040 because you're a single member LLC. A lot of times when we come across that situation, we always ask our taxpayer, if you have a spouse, you're willing to include your spouse in LLC, that will make you LLC outside of your 1040. So your risk is lower, and then your business can be run on the separate book, not in your not under your personal name. So that is so much about LLC. I hope that already gave you some sort of understanding, right? And so let's look at our chart related to the LLC. So this is where I was charting the whole thing, but related to this. So quickly going through flexibility in structure, flexibility in business expense, audit risk, title holding, right? And the member include individual corporation and other LLCs, and then the foreigner part of the LLC. So why not? Could be taxed twice. Single member LLC is the same as sole proprietorship. Okay. The next one I want to talk to you about is s-corp. So why s-corp? People want to do s-corp, right? So the key benefit for s-corp is distribution is not taxed under self-employment tax. So that's the key. And loss is also passed through. That just sounds good, okay? Income pays under 1040. And so here I want to quickly go through why not. Then we return back to the whiteboard because we want to draw again for s-corp. So s-corp has something that we have to know. If you have s-corp, you must deal with reasonable pay determination. Basically, it's a corporation. You can't be making money without anybody working in there, right? So you have a reasonable pay to the owner. And the government don't want you to run away from paying Social Security, Medicare. So they are determined for the owner to get reasonable pay. When you have benefit in s-corp, it's benefiting the whole entire company. So it is difficult to develop benefit just for the owner. So that's why I give a nickname of s-corp as a socialism corporation, because you're really giving benefit out to the vast majority of your employees. If you have more than one employees, that means if you are benefiting yourself for medical insurance, premium deduction, and your employees should have that too. So that's benefit side of things. And S corporation is limited to 100 shareholders. What does that mean? That means you cannot have too many shareholders, only 100. And S corp also cannot take a lot of characters coming into the corporation. The shareholder is defined, cannot be partnership, cannot be corporation, cannot be non-resident alien, and it just cannot be. The only people can be shareholders are the US citizens. So this is where the S-corp restriction comes in. Okay, now let me stop sharing this. Share the whiteboard so we can draw something about S-corp. All right, so I will clear this place and go to. All right, so the way I want to draw S-corp to you, because I want you to understand how that works with your 1040. So this is my S-corp. And I am the only shareholder. And it's okay to have just one shareholder. And then this is my 1040. And I make W-2 income, 50,000. And my S-corp has income because I actually have a small restaurant. So I actually make about 500,000 sales a year. And of course, cost of goods sold, that takes about 100,000 away. That's my food cost. So my gross profit is that. And I have other expenses. Payroll is a big one. I pay a lot of my employees, so I have 200,000 on payroll. And then I have other expenses like rent, utility, that takes another 100,000 out. So I left with 400 minus 300. I left with profit of 100,000. So what happens in S-corp when I have profit of 100,000? So that become, when I file the taxes for this, it become a K1 and it will go into my tax return. K1, 100,000. So this 100,000 add my payroll, so my AGI will be 150,000. I would need to pay taxes for this amount because my W-2, my employer already withhold taxes for me. But this 100,000 profit, I did not have it, so I need to pay taxes. And the taxes on this one is based on my individual tax rate. So in this case, because of my AGI is this amount, so my effective tax rate is about 15%. So I would just pay 15% through 30,000 taxes, and I'm done with my year. So I pay taxes. Okay, so you see in here, I paid income tax. This 100,000 did not pay self-employment tax because there's no such a thing about K1 from S-corp to pay self-employment tax. You don't. Okay, so you got everything over to pay taxes. So in S-corp, the business owner, and always make one mistake is that they went ahead and paid $100,000 taxes, right? But they leave the 100,000 in the business. So it's sitting in the bank account here. A lot of my S-corp business owner will ask me, oh, Ying, can I take the money to myself because I have a corporation? So can I take business money to myself? And in S-corp, whatever you have left in the bank is yours. Because of what? Because everything is taxed already. If you don't take it, you can take it later. But whatever you have left over, it is taxed. What if I didn't run a very good business? What if I only made 300,000 because of coronavirus? My business is not good, and I have losses. I have $100,000 loss. S-corp is brilliant. S-corp allow me to bring the loss over here. S-corp said that I have $50,000 losses. Okay, so I got all the taxes back from here. I paid in about $5,000 in here. Now the government is giving me all back, plus EITC credit and the child tax credit. I probably end up with $15,000 tax refund because of that. Okay, because of the loss. And even more for 2020, folks, for 2020. For 2020, if you got $50,000 loss right here, you can go back 5 years to get tax refund back. So let's say in 2019, you actually had a profit of 50,000. Now you can come back, reduce your 50,000 from 2019, get the money you paid back, refund the taxes back to you. If your 2019, you didn't have any profit, you can go back to 2018. You can go all the way back to 2015 to find the profit and to get the taxes back. This is the power of pass-through. This is your pass-through entity. Okay, so your S-corp is actually can pass on loss, and you can actually get refund back from your prior year. I am talking about 1040. You're looking at your 1040 prior year. You paid taxes. I'm sure you did. So you will get that refund back. Of course, if you say that this business is so new and I don't have the prior year income from the business, that you cannot. But as long as you have the business and made money before, this year you lose money, you have 5 years to go back, right? So this is where I say the S-corp pass-through losses is really attractive. It helps you to get more refund back, okay? And if you made money, it is doing the personal tax rate. So, you know, our corporation tax rate is 21%, right? So our personal tax rate is from 0% all the way to 37% right now. And under Biden's proposal, it will be 0% to 39.6%. But most of the people who are coming onto my webinar, and you may not be affected by that. That means that your AGI need to be greater. Your AGI is greater than 400,000, then you will be impacted by that tax bracket. So right now, and we know that if you are making, if your income bracket is lower, and then of course it is better to stay S-corp instead of paying 21% on corporation rate, right? So this is where the S-corp comes in. So I want you to kind of take away a couple of key points. Number one, S-corp losses pass through, and you can deduct your income. And not like the pass-through, some of the pass-through from LLC, you cannot deduct, and because it has a restriction. But S-corp has no restriction, okay? You can deduct. And if you make income, the S-corp can be taxed lower on the income tax side. And also S-corp doesn't get taxed on self-employment tax. And of course, remember we said there's a why not about S-corp and the reasonable pay determination right here, right here. If you have this S-corp and you are the cook in the restaurant, you cannot say that, well, I'm just not going to pay myself any salary. No, As a business owner, you need to have a reasonable pay. So make sure you pay yourself reasonably. Otherwise, IRS will say that, no, that's not the S-corp we are thinking, because and you need to have a reasonable pay to work on S-corp. But it is possible that you are S-corp shareholder, but you're not working. You are actually just hired people working. In that case, of course, you don't have to pay yourself a salary, but otherwise you need to pay yourself reasonable, right? And then, of course, in this particular example, if I am going to do a 401k benefit for myself, and then I need to make that available to all of my people and with payroll. So S-corp, remember, I nicknamed that as a socialism corporation. So the benefit is a peanut butter approach to everybody. And S-corp can only be a person. You have to be prepared for S-corp result to show up on your tax return. Okay, folks? If you have S-corp, you are right there. You have to show S-corp on your 1040. And if you don't want your 1040 to make a lot of money, then you are not made for S-corp. So S-corp, it is for sure on your 1040. But LLC may not, because the member could be another corporation, right? So your LLC may not show up on your 1040, but your S-corp for sure show up on your 1040. All right, so now let's go for Y C-corp. Let me get my slides going. This is the S-corp. Okay. So Y C-corp. So now we have gone through sole proprietor, LLC, S-corp, now C-corp. Okay. And the C-corp has a benefit. And Coca-Cola is the most famous C-corp. All right. And inside of C-corp, you can classify your owners. You can make some of the owners a citizen, and some of the owners are green card holders. I'm just using immigration terms for that. You can make your shareholders with different right. Some shareholders have no right to vote. Some has right to vote. So that is the class of shares which is not available in S-corp. S-corp, that 100 people in S-corp shareholders, they are equal. They're equal, okay? They are equal. They cannot, if the voting shares are all the same, but not C-corp, they're not equal. And you also can have a limited number of shares. You can, whatever you want. So you can have many shareholders, but they all have a different right. C-corp is a brilliant liability protection to owners, okay? And you probably heard about President Trump had filed many bankruptcies, right? And those bankruptcies are C-corp bankruptcies. That means they protect the owner. So protect him, just the company go bankruptcy. Liability can be written off, and you don't have to pay the bank back, and you just wash your hand, you're done. That's C-corp, the power of C-corp, okay? And the benefit offered inside of the business is tax deductible. So for example, if you are offering executive person a car, it's expense for business. If you have a pension plan, it is expense for business. So everything is expense for business, okay? And the separation of financial connection between the business and the business owner's personal. So important. That's the go ticket for C-corp. Okay. C-corp has a flat rate right now after the Job Act. And President Trump passed the Job Act in 2018 and it made C-corp 21% flat. It saved the big corporations so much money because they used to pay 38%. So now they only pay 21%. But it made small businesses who don't used to pay only pay 15%, now 21%. So it's a different approach, but it is flat. Biden the president-elect and proposed to have a C-corp rate be 28% flat. So we are watching to see how the C-corp plays out. And of course, if it is a loss, if C-corp has a loss, you cannot take that loss to your personal tax return. Goes, well, now I'm going to reduce my personal tax return so I got more refund. No, it doesn't work that way. It stays in C-corp. It's almost like what happens in Vegas stays in Vegas. So what happens inside of C-corp stays in C-corp. It doesn't go anywhere. Okay, so now let's draw something about C-corp to just reinforce your visuals so you actually remember what I was talking about on C-corp. Okay, so this is the last drawing, so we need to clean it up. All right, so C-corp. What is C-corp? C-corp is a basket with a lid. What goes in stays. The bottom is sealed. Nothing can go through C-corp. Okay, this is your C-corp. If in year 1 and you made money, you made 100,000 and you paid 21%, $21,000 taxes. In year 2, you lost 100,000 and you can go back to get a refund of 21,000. In year 3, you lost 200,000. Too bad, and so sad, it just stays there. And in year 4, you made 200,000. No taxes because of this loss. So I give you that example just to have you understand that what's inside of C-corp stays in C-corp. It doesn't come out. So what if I have 1040 here, and I make my W-2 income, and I really don't like, I'm just kind of person that I don't want my business to have any interfere with me. I want to separate these two. And I want business to be just business. What if I lose, you know? So I can write it off. It doesn't affect me personally. And I want my life to be so simple. And that's how you do it. You have a C-corp, so it doesn't relate it to your 1040. And if you have 50,000, you have 3 little kiddos, and you happen to be head of a household, and then you have a lot of child tax credit coming through. You have EITC coming through, and you have a lot of tax credit that you are actually enjoying at this time. And if you're not sure whether your business is gonna create chaos for you or gonna create benefit for you, then it is better to leave that out and never seeing it in your tax return. But remember, if you have an S-corp, S-corp shows up here. If you have an LLC, if you are a member of LLC, it shows up here too. If you have a sole proprietor, that's a Schedule C, it's already here. So the other 3 entities we talked about, they somehow all hovered around your 1040. So your 1040 is affected by these structures. But here, the C-corp seems to be independent. It doesn't have anything to do with you. But of course, if you lose money in C-corp, you're not going to save any taxes either because it stays inside of C-corp. So this is where we want you to understand that when you have a reason to develop something outside of your life, and you stay right here, okay? And this is the best way to shelter business liability from your personal life. That is not the best. That is not the best because they are connected to you. And C-corp is the best. Okay, so this is where I want to make it clear for you, and so you know that the C-corp is right here. Now, connecting to the LLC we talked about. Remember, the LLC can have members as a person, can also have a member as a C-corp. So what if my LLC has the C-corp as the member? That is perfect, right? If you happen to join a venture with your friend, you just don't want that to come into your 1040 for whatever reason. Okay? But you want to join that venture. So what do? You set up C-corp, have the C-corp be the member. So when the LLC give you a K1, the K1 comes here. It will pay taxes, it do the reconciliation on its own and separate it. It's almost like this C-corp is kind of like a grown-up child of yours. Of course you are the shareholder. Of course you are the owner, but doesn't mean you get paid over here. If I don't pay you W-2, if I don't give you dividend, you don't have anything to do with the C-corp. You're just shareholder. There's no difference between you and you owning a share from Microsoft or Coca-Cola, right? So this is where a good planning can save your opportunity of doing business, right? Don't let opportunity go by you just because you don't want the money to come over here. The money don't have to go there. It can go somewhere else. All right. So this is what I want to talk about related to the C-corp. Now, let's go to our next one. Our next one is actually nonprofit. It is really important to understand nonprofit. Why nonprofit? Why nonprofit? I mean, I don't even have money. Why you even talk about nonprofit? They always want donation. Yes, they always want donation because nonprofit is a very useful business structure. Nonprofit is regulated under this special code within IRS. It's called 501c. Okay, nonprofit means none of your profit you will pay income taxes. So you don't pay taxes on nonprofit profit. Okay, you don't have to run negative on nonprofit. Even if you have a profit, you don't pay taxes. That's what nonprofit is all about. Okay, anyone with a noble purpose can set up a nonprofit. I say that again. You can set up a nonprofit. It doesn't need to be United Way. It doesn't need to be something big. Nonprofit can be a purpose that only you want to accomplish, and there's no other nonprofit out there doing exactly what you do. And also, when you set up a nonprofit, you can have family members on the board. There is no articles, there's no code under IRS says that you cannot have your daughter on the nonprofit board with you. So, having said that, if you are doing business, maybe setting up a nonprofit is a good idea. Even if you're not doing business, setting up a nonprofit for the purpose that you want, it may be a good idea. The only drawback for nonprofit is that it's not something you're going to pass on to your children. Okay, it's not your legacy. It can be your legacy, but it's not a private equity that you can give to your children. Okay, anyone can let you go, even though you are the funder, even though you put a lot of money in there. The board can decide to kick you because the board is the one has the power. Whoever on the board, they have the power to kick anybody by majority vote. So if we have 3 board members, and is a mom with 2 kids, and the 2 kids can kick mom out. They can spend money the way they want it inside of nonprofit. Okay, so now let's look at the chart, and I want to draw that again for you because I think those drawings can really help you to remember what we are talking about today. And let's clean my drawing from before, and let's see what we have for nonprofit. So let's say you don't have a business. You don't have a business. You are just an individual. But you have a dream. You have a dream and you want to set up a nonprofit because this is a real story. One of our clients and with a handicapped child on wheelchair. So, they spend a lot of time and money taking care of the handicapped child. So they formed the nonprofit and to buy wheelchairs for other kids. Okay. The couple don't have a business. They just have W-2 income and both of them are making W-2. Then they have this good purpose in life. They want to help other kids could not afford wheelchair. Okay, so they form a nonprofit and they can donate. So their AGI is close to 250,000. They have this one child on wheelchair. And with AGI 250,000, they really don't get CTC. They also don't get EITC because they have a high income. And they regularly donate to the nonprofit to reduce their AGI. Then they pay less taxes. But this nonprofit and has a purpose. And they get money, not just from them, they get money from other companies. So they have big money in here. And here, they can do travel. They can do wheelchair. They can do all kind of expenses. They can even do payroll, and they can even develop benefit for people who work here, and they can pay volunteer. And whatever left over, no taxes, no tax. So that's how you can donate. In 2020, there is 2 big donations you can do. You can donate 100% of your AGI to nonprofit. No limitation this year. You can donate 25% of business income, business profit to nonprofit. You can set up your own nonprofit, folks. This is great. And if you want to reduce your tax liability, and if you have a business, let's say on the other example we had, remember we have a restaurant, s-corp. Remember in one scenario we said our profit was 100,000. That means I can reduce 25,000 profit into the nonprofit because it's 25%. So I will not have 100,000 income anymore. I have 75,000. When I pass that on to my tax return as K1, I pay less taxes, right? So nonprofit. And if you really can discover what you stand for and what your purpose is, that nonprofit will be a very good way to use your dollar efficiently to accomplish certain agenda without paying taxes. So this is where I just simply want to say to you is the nonprofit, you can form one. You don't need to rely on donation to United Way, have them go around and accomplish the purpose you want them to accomplish. Maybe they never do. And or you don't need to rely on any other existing nonprofit and you can do it on your own. The only thing I want you to know is the nonprofit, it is not a private company. So you cannot pass on nonprofit like you pass on your jewelries, you pass on your restaurant to your children. And they are an entity that fulfilling a nonprofit purpose. So it is non-taxable as our IRS code dictates. So this is where the nonprofit is all about. Okay. Now I have my last slides. Oh my goodness, we're going over time. I cannot, okay, I'm just gonna do the last slides really quickly and I don't want to go over time. Okay, so just very quickly, consider more of the secret, which is the physical year versus calendar year. And this is another layer of consideration. When you have a business entity, you want to see whether it is necessary to just go from January to December, or you want to make that from maybe July to June. So those fiscal year can help you to delay taxes or benefiting your making your tax due more efficient. Accounting method would be cash method, accrual method, has a lot to do with your taxes. If you felt like you didn't even make the money yet, but you pay a lot of taxes, maybe your accounting method is wrong. So that's what I want you to know. Just know that I know I didn't really explain extensively. I don't have any more time, but I want you to know that is a possibility for you to reduce taxes when your accounting method is different. And the closure of business, don't ever forget, when you close your business and you have a huge possibility to get a refund, and don't let that closure be unknown. Let your tax people know you closed your business because you can get big money back. The layer of structure for protection, this is where from LLC can go into corporation, from corporation can go to you. So there's a layer of structure you can do. NOL, I kind of touched on it, is a net operating loss, and which you have 5 years going back, right? So that is a CARES Act. And I have other webinars that talk about that. And if you can go to YouTube to take a look at that. Donation, I talked about it on the nonprofit. Benefit can be built in the nonprofit, can be built in your business. If it is a C-corp, it's deducted as a business expense. If it is an s-corp, make sure that benefit goes with everybody. So that's really, there's more things we can do related to the structure, but I will conclude my today's talk this way and have you lingering with some curiosities so you can go on to YouTube to check out more information, folks. I hope you learned something and very happy that you're here, and we will talk to you again. Bye-bye.